How can you supersize your stock market gains without taking more risk? Well, I've got 26 ways that I'm going to share with you today. And what you're about to see applies to all investors in all markets, not just stocks, but cryptos and real estate and collectibles. Don't go anywhere. Stick around. I'm Ron DeLegge with ETF Guide TV. A warm welcome to all. If you're here for the first time, be sure to hit the subscribe button. Become a regular viewer and enjoy our grab bag of awesomeness that we produce on this channel. Now, the inspiration for this video comes from my book, Habits of the Investing Greats, which was similarly structured into a 26-week habit practicing system. In this video, I'm going to give you 26 ways for supersizing your stock market gains, and I picked that number deliberately because I want you to practice each one of these strategies over the course of the next 26 weeks, 1 week at a time, one strategy at a time. And then I'm going to give you a homework assignment right now. You're going to report back to me because I want to notice or see if you've noticed a positive difference in your own investing results. So you're going to report back to me, post your comments below in the comments section, and let me know how you're coming along. You can hit me up after the first week or after 6 weeks or after 26 weeks, however often that you want, and I encourage you to do that. Now, the chief purpose of investing, and sometimes we forget this, it's not to invest because it's fun. We don't invest because it's entertaining or because it's educational. The chief purpose of all investing, regardless of the person, regardless of the time horizon, and regardless of the goal, is to have a profitable outcome. Never lose sight of that. Now, I want you to bookmark this video, rewatch it. Please share it with everyone you know. For experienced investors, it's a good reminder of all the things that embody profitable investing. And for newbies, it's a fundamental roadmap of how and where to begin your investment journey. So, without further ado, let's get started. We begin first with paying yourself first. A great place to start. And those that pay themselves first, what they're really doing is just showing that they have some self-respect, right? You can do this by simply saving a portion of your income and investing your money, right? You cannot expect to get ahead financially if you're paying everybody first all the time. Those of you that say, well, listen, I've got bills to pay, I've got debt. Well, all of us are guaranteed to have bills for the rest of our adult lives, and if you wait to pay off all your bills before you start the habit of saving and investing, well, you're never going to get ahead and you're never going to get started. So pay yourself first. It's been said that procrastination is like a credit card. It's fun until you get the bill. Well, investing great Bernard Baruch once said that now is the hardest time to invest. So here's an idea. Instead of procrastinating, I'm going to give you a better approach. Don't wait to start investing. Invest and then wait. Next up is compounding your money. It's been said that compounding interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. That's what Albert Einstein once said. And this chart illustrates that very point. You'll notice the power of compounding interest over long periods of time. And you'll see Investor 1 saves the same dollar amount as Investor 2. Investor 1 starts earlier and then after 10 years stops saving. You'll notice Investor 2 gets started a little bit later and they invest over a shorter period of time, but they invest the same amount of money. But you'll notice that at the end period that we're illustrating here, Investor 1 has more money than Investor 2. And why is that? Well, it's because Investor 1 got an early start and their money was able to compound over a longer period of time. All that time worked to their favor. And so this is a really good lesson in the importance of compounding your money. Next up, we want to aggressively cut investment portfolio, the fees and the cost associated with that. And let's illustrate that by means of some numbers. It was investing great John Bogle that once said and researched that financial middlemen take around 2.5% from an investor's returns. And in this example, you see investor has set aside a modest sum of $2,750 a year. That grows at an 8% annual return. And then assuming no withdrawals on that money are made, it grows into an impressive $3.7 million But you'll notice the red line illustrates what they get to keep after paying financial middlemen like fund companies and money managers and financial advisors. They net just over $800,000, which is a far cry from the $3.7 million number. So put another way, if we look at this, what we're saying here is 78% of their investments were stolen away by high and unnecessary cost. That totally avoidable cost, by the way. And so the lesson again is you must be aggressive and you must be relentless at minimizing investment costs. An easy way to do this, of course, is to use index ETFs as the foundation of your portfolio to keep your costs low. Next up is to stop chasing past performance. It's tempting for all of us to chase the hot performing stocks or hot performing cryptos or whatever other investments that were last year's winners. And if you invest this way, I'm warning you, you're cruising for a bruising, because the odds of a profitable outcome simply are not in your favor. There have been many studies that prove this to be true. Vanguard did a 10-year study of over 3,500 U.S. stock funds, and guess what they found? Investors who chased past performance consistently and substantially underperformed buy and hold investors in all equity categories. And if I'm going to warn you about the danger of chasing past performance, well then I got to warn you about the danger of chasing high yields. Whether that be dividend paying stocks or bond yields, it's hindsight investing, and it carries very similar risk to chasing past performance. I mean, in the long run, more people have been hurt by chasing high yields than have been helped. And the history books are filled with people that crashed and burned their money chasing yields. The meltdown in high-yielding real estate investment trusts during the 2008 financial crisis is just one example of many. You always want to invest with a safety cushion, and especially investors that are at, near, or already in retirement, you need a little bit of a larger safety cushion so that you can ride out those bad and unfriendly markets. Let's talk linguistics for a minute. If we break down the word invest, it comes from the Latin word vestir. Now, anybody watching this speaks Spanish, because if you speak Spanish, then you know this word. Vestir means to get dressed, and that's the same word which is derived from invest. And so what you're doing when you get dressed is you're putting on clothing, and that protects you from the outside elements. And so in a similar way, your approach to investing should always be conscious of not just making money, but protecting your wealth. ¿Me entiendes? Muy bien, amigos. Next up is to practice both patience and perseverance. Now, it's been said that the stock market is a device for transferring wealth from the impatient to the patient. And your investments, well, they're like a garden. They need time to grow. And so perseverance is just one step beyond patience, because it doesn't just wait, but it endures even when the stock market and everything else seems to be broken and not working. And here's what Yoda Buffett had to say about being patient. A pretty funny quote. Basically, you cannot produce a baby in 1 month by getting 9 women pregnant. Pretty good point. Stop trying to predict or time a stock market correction or crash. Now, the sooner you realize and understand that nobody, including you, can consistently or accurately predict the stock market's next move, the better off you're going to be. Stock market crashes have happened in the past. They will happen again in the future. So it's much better to prepare yourself financially and emotionally to ride through that next downturn instead of trying to fixate on the exact moment or minute when that's going to happen. And one more thing about this, beware of financial hucksters, and some of them are even on YouTube, who claim that they've accurately predicted a stock market crash. Well, most of these claims are unsubstantiated, and most of these claims are from individuals who have lost their followers a boatload of money with all of their false alarms and mistimed trades. Next up is to diversify your holdings. So a well-diversified portfolio should have exposure to all the major asset classes: stocks, bonds, real estate, commodities, and cash. And index ETFs that act as a proxy of these asset classes is definitely a good place to start. If you want to add non-core assets like collectibles or NFTs or cryptocurrencies, that's fine, you can do that. But be careful of over-diversification, which basically means you own too much of the same stuff. And this is what investing great Sir John Templeton, he reminded us about the importance of being diversified, because it's simply impossible to correctly time the market 100% of the time. Now, another point that I want to make is the importance of minimizing taxes aggressively but legally. So having too much money inside your taxable bucket and your tax deferred bucket, like your IRA and your 401k plan, and not enough in your tax-free bucket, like your Roth IRA and your Roth 401k, it could expose you to higher taxes down the road. And really, that's where we're heading as a nation. We're heading into a high tax rate environment. The government cannot continue all this overspending. They're going to have to increase tax rates in order to pay for all this. And so repositioning money right now, before those tax rates go up, we want to reposition money in the tax-free zone. You can do that via Roth IRA conversions. That's just one example of how to get that money into the tax-free zone. And again, you want to diffuse the nuclear bomb of skyrocketing taxes before it happens. Next up is stop being reactionary. Well, sometimes we make emotional or knee-jerk reactions or decisions, and boy, is that a lousy way to invest. It's a lousy way to live. Now, one of my favorite studies that proves this out, it was done by a team of professors from Stanford University and the University of Iowa. They examined the side-by-side results of brain-damaged investors versus a group of those without a mental handicap. And guess who outperformed? Well, both groups started with the same $20, and if they won a coin toss, they were rewarded with $2.50 on top of that. Whereas if they lost the coin toss, $1 was removed. So after 20 rounds of coin flipping, the brain damage group turned $20 into $25.70, while the non-brain damage group earned less by turning $20 into just $22.80. So why did the brain damage group do better? Well, because they didn't fall victim to the emotional trappings associated with pain of loss. Instead, they kept a more logical path of continuing to invest despite the setbacks. So keep that in mind during the next bear market. Next up is to index your portfolio to the market. Now, if the data does not prove that indexing wins, well, guess what? The data are completely wrong. And that's what investing great John Bogle once said. And so you want to make sure that you invest like a winner, not like a loser. And you do that by aligning your money to the market, simply by using index ETFs. That's a good way to do this. And that should be the foundation or the core of your investment portfolio. In the end, indexing may not be the best investment strategy ever invented, but the number of worse strategies is infinite. Next up is the importance of writing it down. So an investment plan that is not written is not much of a plan at all. And all investors, new and experienced, should absolutely have a written investment plan that lays out important things like your portfolio's investment positioning, your asset positioning, your asset allocation, the types of investments that you're going to use to help you reach your goals. And by the way, I have templates in my online class that you can use. You just plug in your data and bam, you've got a written investment policy statement, also known as the IPS. You're way ahead of most people. Next is to not be envious of others. Someone's always going to be getting richer faster than you, and this is not a tragedy. That's what investing great Charlie Munger once said. Here's the problem. It can become a tragedy if it leads us to become envious of others, especially when we see people making crazy money, people that we don't think deserve that, or people that we think are inferior to ourselves. And that could cause us to live a lifestyle that we cannot afford to live, or maybe to invest in a super risky ways. Avoid envy. Next, think and invest like a contrarian. Some of the greatest investors of all time made their fortunes by buying investments that were temporarily beaten down or out of favor. So take a look at the stocks or ETFs trading at or near 52-week lows. Even though they're out of favor now, maybe it's because of just a temporary setback, or maybe the market failing to appreciate the value of these assets. So contrarian does the opposite of the crowd by arbitraging these market dislocations and acquiring wonderful assets at fire sale prices. My number one rule for investing in individual stocks, if you're going to do it, is that the company must be founder-led in industry sectors with high growth and lots of innovation. And if you take a look at most of the great technology companies of our era, companies like Apple and Google, Amazon.com, Dell, Facebook, and so many others, all had this in common: founder-led CEOs that ran the company for a very long time. Now, this is not a fail-proof system because there are some company founders that are complete knuckleheads, but I think it's still a good rule. In fact, Bain & Company did a 25-year study, and they found that companies with founder-led CEOs tended to do better than the S&P 500, and so that's an important thing to keep in mind if you want outperformance. Next up is to keep your winners and sell your losers. It was investing great Peter Lynch who regretted selling his winning stocks way too soon, and it's hard to imagine somebody of Lynch's stature regretting anything. But Lynch said, quote, "Selling your winners and holding on to your losers is like cutting the flowers and watering the weeds." Any further questions? Good. I didn't think so. Next up is to avoid margin. And now this one might seem like a little bit of a contradiction because investing with borrowed money or margin can actually magnify your gains when the stuff that you're buying goes up. But what happens if things go wrong? Well, the opposite's true because margin actually magnifies your losses, and just one mistake can quickly wipe out years of gains. And the history books are filled with sad stories of institutions and individuals who self-destructed because they were over-leveraged. So if you want to use a little bit of margin, that's your business. I just say it's better to avoid it altogether. Mind your risk. Well, this is related to margin. The risk character of your investments should always perfectly match your risk profile. Now that means if you're not a teenager, then stop investing like one. Conversely, if you are a teenager, well, stop investing like a retiree. So how you invest should match your age, your investment time horizon. It should also match your tolerance to handle the crazy ups and downs of financial markets. It's hard to keep track of all your money when it's scattered about in far-flung places, let alone trying to properly manage it. Most people don't need more than just a few investment accounts at one or two institutions max. I recommend keeping your money at institutions that have a history of customer-friendly behavior with a proven track record in both bull and bear markets. Avoid companies that have poor customer service or make it their principal business to sell your information to unrelated third parties. The tendency of all humans, including me, is to accumulate stuff. And sometimes this unnecessary clutter makes its way into our IRAs and 401k plans and other investments. So go on a seek and destroy mission and eliminate those investments, those stocks, mutual funds, ETFs, or whatever else that no longer meet your investment goals or complement the rest of your holdings. Decluttering is all about simplifying your financial life and lessening the burden of unnecessary junk. Next, we want to study and learn from the investing greats. How did they turn a little money into a lot? What were their secrets? How did they do it? What were their habits? You must study and learn from the investing greats if you want to become an investing great yourself. And by the way, anyone can become an investing great regardless of your age or race or gender or circumstances. Repeat after me, and this is your homework assignment. I am an investing great because I think and I behave like a winner. One more time for emphasis. Repeat after me. I am an investing great because I think and I behave like a winner. Now, after this video is done, you're going to look at yourself in the mirror and you're going to say that to your face 10 times in a row. Remember that movie Cool Hand Luke? One of the famous lines in that movie was, "You got to get your mind right, Luke." Well, here's what that means for you. Before you can get your money right, you first got to get your mind right. That means cultivating the right psychology, the habits of a winner and of the investing greats, and certainly having a proven investment philosophy that minimizes costs, reduces taxes, controls risk, and puts profitability as the number one priority. That's a good start. In fact, you want to build an investment portfolio so indestructible that not even you, crazy you, can accidentally destroy it on your worst day. Failing to measure your portfolio's results is akin to playing a game of sports without keeping score. But you see, your investments are not a game. So you need to know the strengths and the weaknesses of your portfolio so that you can eliminate the weak spots or your blind spots and build on the strengths. You should be paying acute attention to things like your portfolio's cost, risk, tax, diversification, organization, performance. And by the way, these are all factors that are part of the portfolio report card grading engine that I built. Last up is to explain to your loved ones and those that stand to benefit from your money or inheriting it what your investment philosophy is, why it works, and how you'd like them to invest. Your philosophy is more important than teaching them the mechanics of how to execute a trade or how to sell covered calls or how to read a chart. None of that is more important than explaining to them your philosophy. So that does it for today's episode. Be sure to revisit the resources in the description section below. I've got books, online classes, a portfolio grading system to help you understand the strengths and weaknesses of your portfolio. We covered a lot of ground in today's episode. Be sure to bookmark this video, rewatch it over and over again, share it with everybody you know. Let it be a source of motivation. And don't forget to report back to me because I want to hear from you. I want to see how you're progressing over the course of the next 26 weeks, practicing these strategies that I've shared with you for supersizing your investment returns. And I'm confident that you're going to see improvement. And guess what? I'm rooting for you. Thanks for watching. I'm Ron DeLegge. We'll see you next time.